This is Satya Prediman of Cirrus Research. The latest signals report is just out. This is our asset allocation work. The title, The Fog of War to Continue Benefiting Short Duration. What we've seen, at least in the initial 30 some odd days of this war, is that the market has certainly rushed towards a more defensive fetal posture. Outside of the energy sector, groups such as telecom and utilities have lost the least amount of ground. Let's put it that way. Our arguments here is that by chance, this sort of Iran conflict has coincided with really some of the fundamental signals that we're seeing in the marketplace. Bottom line, shortening duration, becoming more valuation sensitive. These were elements that were already in place, and it's quite possible that maybe the conflict might exacerbate that sort of broadening call that we've made in the past year. In terms of the key drivers of the asset allocation work, our asset allocation model between stocks and bonds continues to underweight equities. Part two is that the size factor is neutral. In other words, it's not a very large cap dominated world. From a style standpoint, it remains in lean value. In other words, if you're going to lean towards a valuation friendly marketplace, by definition, you cannot be sort of anchored among larger stocks where that's the most expensive segment of the equity market. Risk appetites are neutral. That's actually a little bit of a misnomer. What's really going on there is that risk appetite had been incredibly speculative. We're certainly seeing that reading now repel lower. However, it's far from a very defensive crouch. In other words, there's room here for investors to become more defensive. And finally, crowding is not a problem. We've certainly broken leadership, and I think the market's still in search of forming leadership. This is a look at the actual asset allocation model, and as you can see, there's like an 87% allocation to fixed income. In terms of the short versus long duration bet on the fixed income side, it's definitely a short duration call there as well. But at the heart of this, besides valuations being a concern, what's also starting to surface is that credit spreads are quietly starting to widen. Bear in mind, we've been in 30-year lows with how bullish these spreads were. So the environment is certainly not awful, but it's certainly starting to creep wider, especially with the uncertainties and the vagaries of war. In terms of the style oscillator, this is also squarely a valuation leaning or value overweight bias. This has been here the past year. When you look at it globally, I think to some degree it's worked to see all these undervalued markets, whether it's emerging markets, international markets, outperform the States. And in the most recent 12-month window, we've also seen smaller stocks outperform. And that's not because people want risk. They're just broadening their bet right now, leaning away from the most expensive parts of the marketplace, I think. This risk appetite score really hammers home the point that, yes, we're no longer in that speculative sort of exodus that we were in the prior 6-9 months. We have seen this pare back, but it's materially well north of where the market could be considered in a defensive crouch. So we're not there. And the longer this war goes on, I think the more likely this reading is going to get more extreme. And again, it underscores our shorter duration bias. Take a look at the full report, and as always, happy to take your questions. Thank you.